Everyone talks about buying a business for passive income. Solid cash flow while you chill on the beach somewhere. But here's the truth. Buying a business isn't about finding a magic ATM. It's about learning the game behind the deal. Because the people who build real freedom don't buy random listings. They follow a system. And in this video, I'm going to walk you through the exact system that I've used personally to buy a 6-figure brand and turn it into a high 7-figures brand in less than 12 months, step by step. By the end, you'll know how to stop guessing, spot real opportunities, and move from scrolling listings to owning a brand that actually pays you. All right, let's start with level 1, the tourist. This is where you start. You spend hours scrolling through marketplaces like Flippa or Empire Flippers. You watch videos about buying businesses. But at this stage, it's mainly browsing and not enough action. The biggest trap here is the shiny object syndrome. Everything looks exciting, but there is no plan or filter to separate a good opportunity from a bad one. At this stage, you're not buying, you're learning the landscape. You're exploring what exists and building a mini database of insights. Start tracking verticals like fashion, beauty, home and kitchen, toys. Track revenue versus profit so you see how earnings convert to valuations. Track valuation multiples so you understand how different niches are priced. And once you have looked at 20 to 30 listings, you will start to notice patterns. You will see which types of brands command higher multiples and which ones are hype. To make this practical, set a couple of simple filters early on. Look for profitable brands only. You don't want your very first deal to be a turnaround project. Save the rescues for later. Right now, you're looking for something stable, simple, and cash flow positive. So look for a minimum gross margin of, say, at least 70%. These filters help you cut bad deals fast. The goal right now is familiarity. Get familiar enough and you will recognize value when it appears. When that happens, you have cleared level 1. Level 2, discounter. Now you're looking at deals with intent. You're signing NDAs, you're reviewing teasers, maybe even jumping on your first broker calls. This is where you start building pattern recognition, learning to separate great opportunities from great marketing. Here is your red flag checklist. If any of these show up, walk away. Number 1, when most of the revenue comes from one product. Number 2, when there is only one supplier and no backup. Number 3, when all of the traffic comes from one ad channel that lives and dies by the algorithm. If you see any of those, that is not a business. This is a house of cards with good branding. Now let's talk about the numbers that actually matter. A healthy brand should be bringing in customers who stick around. You want a lifetime value that is at least 3 times what it costs to acquire that customer. You want clean financials, especially if you plan to use bank financing. And you want steady month-to-month cash flow growth. Banks will care about 3 things. 1, consistent profitability. 2, at least 2 years of operating history. And 3, clean financial records that show the business can sustain itself. And trust me, this seller will always say everything is passive. They will tell you the profit is clean and the brand runs itself. They will also tell you that the dog ate the receipts for the last 6 months. But trust the profit and loss statement, not the bedtime story. Level 3, the offerer. This is the point where things start to get exciting and a little bit more serious. You're not window shopping anymore. You're making offers. You're sending out letters of intent. You're running deal calculators and you're talking to lenders. This is where you learn deal math and how to protect yourself. Let's talk about ad backs. Those sneaky numbers sellers use to make the deal look prettier than it really is. For example, they might add back their $200 owner salary. They will tell you that once you take over, you will not need it. But if you still need to hire a manager for $100,000 and maybe another one for another function, your true add back is only half of that, not the full $200,000. When you send an offer, protect yourself with a strong due diligence clause. You want the freedom to walk away if anything in the numbers operations turns out differently. That includes financial discrepancies, supply contracts with bad terms, unclear ownership of trademarks, or domains still sitting under the seller's name. And anything that touches the core of the business should be verified before you close, because this happens more often than you can imagine. So challenge every line item, especially the mysterious miscellaneous. Level 4, the closer. This is a big moment. You've made it past the offers, and now you actually own a brand. You've signed the agreement, transferred the accounts, onboarded suppliers, and you are officially in the game. This is where excitement and pressure are both high. But this is also where many first-time buyers get their wake-up call. You start digging into the business more closely, and sometimes what you find isn't exactly what was promised. This is where gaps in due diligence start showing up. Maybe the traffic isn't as stable as it seemed before. Maybe profit margins were overstated. Or maybe key parts of the business relied more on the previous owner than you realized. This level teaches you how important it is to ask the right questions during due diligence. Not just what's on the surface, but the things that actually keep the business running day to day. You also learn to separate headline numbers, the ones that look great in a broker's deck, from the real numbers that drive cash flow. The next 3 months are about control and calm. First, lock down everything. Change passwords. Add two-factor authentication. Check that you actually have access to every domain and payment account. Next, secure your supply chain. Count your inventory. Place restock orders. Make sure nothing goes out of stock while you're celebrating your big purchase. Finally, review your top ad campaigns. Kill anything that is wasting money. Keep the cash flow steady before you even think about scaling. The goal right now is not growth, it is stability. Get that right, and the rest becomes easy. Level 5, the operator. This is where you start running your business towards growth. You've stabilized things after the deal. Now it's about building real systems, driving growth, and making the business stronger every single week. At this stage, you're managing a brand with structure and intention. You're looking at your key numbers like revenue, profit, inventory, and marketing performance on a weekly basis, maybe even daily. You might bring your first hires or build a small team. Before you start hiring, set up your structure. Use Notion to create simple standard operating procedures, SOPs. Start with the basics. You don't need to do everything yourself. In fact, you shouldn't. Start by being honest about where you're weak. If operations and supply chain stress you out, bring in someone who loves that part. If marketing isn't your strong suit, hire a solid performance marketeer who can drive growth while you focus on strategy. If you're great at product but bad at numbers, get a finance lead or a fractional CFO. This is where you build what I call the ops triangle. Each person you bring on should have a clear focus. One owns supply and inventory flow. One owns marketing performance and customer acquisition. One keeps profit steady and cash flow healthy. That balance gives you a business stability and direction. Once your team is in place, your job is to tighten the machine. Review your product lineup, cut what doesn't sell, keep improving how you retain customers and convert traffic, start mastering the real growth levers, paid ads, SEO, influencer campaigns, even retail if it fits. This is also where many first-time operators get humbled. When I bought my first brand, we ran out of stock in month 2. It killed sales, created chaos, and cost more than it should have. That's what I learned. Growth isn't about selling more. It's about keeping every part of the business working in sync. So stay focused on system health, not just sales spikes. Level 6, this system builder. This is the level where everything changes. You're no longer deep in the day-to-day of the business. The system and the people you've built now run the brand for you. You have a trusted operator or general manager in place. You've got clean dashboards and scorecards that give you a clear picture on how the business is performing without needing to check in every single hour. Your team knows what they're doing and doesn't rely on you to make every single decision. But even though it feels great to step back, this stage comes with its own risks. The biggest one is key person dependency. If your operator or one key team member disappears, the entire system can wobble. And if your processes only live in people's heads, not in clear documentation, SOPs, you are exposed. So the next step here is all about leadership redundancy and process clarity. Use the Loom and SOP combo. Every recurring task gets recorded in a quick Loom video. Then that video is attached to a written SOP in Notion or Google Docs. If there is no Loom, there is no SOP. Then you build your dashboard stack. There are plenty of tools out there to help you track what matters, from analyzing paid campaigns and SEO performance to keeping an eye on inventory and finances overall. Your top dashboard metrics should stay simple: monthly profit, cash on hand, and inventory levels by SKU. And of course, you can have SKU, unit economics, and metrics as well. Those three, though, will tell you more than any 20-page report ever could. That way, you always know what is happening without being stuck in the weeds. You're informed, not involved. You want backup operators. You want systems that are easy to hand off. You want structured weekly business reviews and layered scorecards that keep performance visible and accountable without you having to be in the weeds. This is also the level where your focus starts to shift. Instead of asking, how do I grow this one brand? You start asking, what's the next smart brand I can buy? Your time and mental space are no longer spent fighting fires. They are spent thinking strategically about growth, capital, and acquisitions. And that's what sets you up for the final stage of this ladder. Level 7, the roll-up architect. You're now at the top of the game. You're no longer running just one brand. You're building something bigger, a true portfolio. At this level, you might have 2, 5, or even 10 brands working together. You build shared systems, supply chain, creative ads, operations, all running under one engine. But once you start growing fast, the biggest challenge becomes focus. It's easy to end up with 5 different dashboards, 3 email marketing systems, 7 CRMs, and 3 project management tools all trying to talk to each other. That is what I call a Franken-stack. A bunch of systems stitched together that technically work, just not together and not in practice. It's like you build your own Frankenstein monster out of software, and every Monday morning it comes alive just to chase you around your inbox. So the goal here is to avoid creating that monster and keep things simple. Centralize your core system, one support tool, one accounting setup, one clean source of truth for data. Now, this is also where roll-ups really start to make sense. You can leverage everything you've already built, your systems, your team, your suppliers, your creative processes across multiple brands all at once. By brands that live in the same ecosystem. Maybe you go in on home and kitchen, or maybe you specialize in health and wellness. That way you can cross-market products to the same audience, share data, and stretch your ad dollars further. Another way to think about it is by platform. You could focus only on Amazon brands, or only on Shopify brands, or go even deeper, Amazon beauty brands or Shopify home brands. That kind of focus gives you tighter operations, stronger synergies, and cleaner wealth creation. every new acquisition plugs right into the same system, same logistics, same team, same data flow. And with each deal, you get sharper, faster, and more profitable. You'll also start pruning. Sell off underperforming brands and replace them with better ones. Or package your entire portfolio and sell it to a larger consumer group that wants to expand into that niche, especially if your brands can add meaningful revenue to what that bigger group already does. That's the real power at this level. You're not just buying yourself freedom anymore, you're building an asset that compounds. Each new deal adds leverage. Each brand strengthens the entire system. This is where you stop being just a business owner and start thinking like a true portfolio architect. To make that climb easier, I've put everything I know into the ultimate consumer brand acquisition and growth guide. It includes everything you need at each level to take the best steps forward. The link is down in the description. So to conclude this video, these are the 7 levels of owning and scaling a brand or multiple brands. Each level builds up on the last one and gives you more leverage to create real freedom. Now ask yourself, what level are you currently at, and what's your next move to go one step higher?